The cost of owning an electric car will draw level with that of the traditional combustion engine vehicle as early as next year in Europe, leading to an earlier than expected adoption of battery vehicles by the public, at least according to UBS. The bank predicts an inflection point for demand for battery-driven vehicles after physically tearing apart a Chevrolet Volt, the first mass-market, long-range electric vehicle to examine its parts and to determine its true production costs. It estimated that the Bolt cost $28,700 to manufacture, significantly less than expected, whilst its electric motor contains just 3 moving parts, compared with 113 for the engine of a Volkswagen Golf. This, they estimate, translates into lower annual maintenance costs, just $255 for the Bolt compared with $610 for the Golf. According to the bank, therefore, the total cost of ownership, which includes fuel and other running costs, will draw level with traditionally powered vehicles next year in Europe, in 2023 for China, and 2025 for the US. Patrick Hummel, the UBS analyst who led the research, said, "People focus on the sticker price, but they underestimate the difference in the cost of running the vehicle. There is likely to be more demand than we previously thought." As a result, UBS has raised its expectations for global electric vehicle sales by 50%, predicting that 40% of all cars sold globally in 2025 will be battery driven, and electric vehicles will account for 1 in 3 cars sold in Europe. At present, sales of electric and hybrid cars are less than 1% globally, held back by the high price and limited range of the current vehicles on the market, as well as the relative lack of charging infrastructure. The Bolt has a price tag of $37,000 and an advertised range of 238 miles before needing to recharge, making it the first long-range electric car on the market to compete in terms of price with traditionally powered vehicles. Before 2020, most major manufacturers will launch similarly capable models, including Tesla's Model 3, which is due to launch later this year. Indeed, UBS estimates that General Motors will sell the Bolt for a $7,400 loss per vehicle initially due to high fixed costs and small initial production numbers. However, the car maker could make a 5% profit margin on vehicles by 2025 due to improvements in scale and battery technology. If estimates for the Bolt hold true for Tesla's Model 3, the electric US car company could start to make a profit on each vehicle at a selling price of $41,000. That's $6,000 higher than the expected base price. Tesla could achieve this by convincing consumers to buy additional high-margin options such as the much-praised driverless technology functions. These are just 2 examples, of course, but what of the broader market? In the US, first quarter numbers for 2017 show a 70% year-on-year sales increase in electric vehicles, and this has continued the strong momentum from 2016. By the end of 2016, there were 30 different electric vehicle offerings with a total sales of 160,000 vehicles. 5 different models sold at least 10,000 units last year: Tesla's Model S, Tesla Model X, Chevrolet Volt, Nissan Leaf, and Ford's Fusion Energy. More than half of the sales occurred in California, driven by the state's zero vehicle emission mandate, which requires that a certain percentage of a car maker's sales must be zero emission. California's goal is to put 1.5 million electric vehicles on the state's roads by 2025. Whilst there's no doubt this is an ambitious target, many in the car and energy industry believe that the fastest growth will be outside North America. They highlight tighter emission rules in China and Europe especially that leave global car makers and consumers with little choice but to embrace plug-in vehicles, therefore fueling an investment surge. In Europe, green cars benefit increasingly from subsidies, tax breaks, and other perks, whilst combustion engines face mounting penalties including driving and parking restrictions. China, struggling with catastrophic pollution levels in major cities, is aggressively pushing plug-in vehicles. Its carrot and stick approach combines tens of billions of yuan of investment in research funding with subsidies and regulations designed to discourage driving fossil fuel cars in big cities. While sales remain strong, the road ahead for electric vehicles in the United States, however, could be fairly bumpy. Regulators in California and a group of other US states are pushing ahead with state-level rules that mandate rising quotas for electric or zero-emission vehicles. However, President Trump has pledged to roll back environmental and climate rules. Groups representing established car makers asked President Trump to review the previous administration's fuel economy targets. Vehicle makers have also encouraged Trump to work towards a single national set of rules to govern vehicle greenhouse emission standards. This move could spark a legal challenge to electric car quotas in California and other states on the grounds that they present a separate standard. Still, industry executives in Detroit said hitting the brakes on electric vehicles in the United States would not relieve pressure to bring them to market because China and Europe especially are forging ahead with policies to expand the sales of plug-in cars. But to drive the shift to electric, industry executives say they need more help from governments. Across China, Europe, and the United States, car makers are advocating for new infrastructure money to go into public electric car charging networks. In the United States, electric vehicle manufacturers are pushing for the continuation of a $7,500 federal tax subsidy that goes to consumers who buy a fully electric car. Of course, the final scale and depth of the electric vehicle market remains to be seen. However, the Chinese electric car market is starting to cast its shadow over Detroit. IHS Automotive, a research agency, predicts Chinese plug-in deliveries will hit 1 million in 2019, 4 years ahead of the United States. Gérard Depardieu, a Renault-Nissan executive leading low-cost plug-in development, said recently, "Look to China rather than the US for the future of electric car sales. China is compelled to act. That is the main difference."